So that's what changed. The one-day lending rate. Everybody's up in a tizzy. Everybody wants to know, should I pay off my mortgage? Well, not everybody, because not everybody has a mortgage. They can't be true. And then half the people who do have mortgages have like less than 3%. I just saw one this week. 2.25. Doesn't that feel like a different lifetime ago? 2.25. Never going to pay that one off. Why do people want to pay off their mortgage? Because they think interest rates went down. That's what I heard. Interest rates went down. Okay, what do? Let's see. September 18th, interest rates get cut by 50 basis points, 0.5%. Do you guys actually know what that means? Does anybody know what that means? Interest rates got cut by 0.5%. Blah! That's what it sounds like when people say that on the internet to me. What are you talking about? Do you know who had their interest rates get cut by 0.5%? Because it wasn't you and me. I mean, that might be the second or third order effect of it. Maybe. If you're lucky or unlucky, it depends. The only people who had their interest rates get cut by 0.5% are the banks that lend each other money every night, or the government that lends them that money. That's it. How long is the duration of that loan? 1 day. So that's what changed. The one-day lending rate. Everybody's up in a tizzy. How long is a mortgage? Most of them, 30 years. Do you think that has an effect? Do you think the one-day lending rate has an effect on the 30-day lending rate? I'm pretty sure interest rates got cut. This is a few weeks ago, whatever. And I'm pretty sure the 10-year treasury rate went up. I'm going to check that. Sorry, this is my first time on the internet. 10-year real treasury rate. You guys are like, what is he looking at? I don't even know. Oh, wow. I'm not lying. 10-year treasury rates. Let me see if I can speak through this graph. Interest rates. I'm going to just air quote interest rates really quick. Interest rates got cut on September 18th. Okay. Interest rates. The 10-year treasury rate. No, wait, hold on. What am I looking at? Don't call me stupid. I was just looking at the wrong thing. Everybody does it sometimes. Okay. Don't pretend like you're not an idiot. 10-year treasury rate on September 18th. This is real. 3.7. Okay. Today it's 3.79. Interest rates got cut. Which ones? I don't know. What does that mean? I don't know. I just hate when people say stuff is so absolute. It's like interest rates. Which interest rate? All of them. Are you sure? What are you even talking about? Well, the federal funds rate went down, but the 10-year treasury went up. So which one's real life? I don't know. They both are. So what I think is hilarious is you look at a 30-year mortgage. Pretty normal product, actually. I would say that on average, most people have interacted with a 30-year mortgage. You have taken one out yourself. You've lived in somebody else's house who had one. It's a pretty common thing to inform some portion of your life. Do you know what drives 30-year mortgage rates? Let me tell you what doesn't drive 30-year mortgage rates. The interest rate environment. The only thing that drives 30-year mortgage rates is the open market. It's 30 years. There is no one in the world who can give you a confident opinion about what interest rates are going to do for the next 30 years. And if they do, they're actually an idiot. If you can tell me with confidence that you know what's going to happen for interest rates over the next 30 years, you are literally dumb as shit. Nobody knows what's going to happen. Nobody knows what's going to happen. But we take all these 30-year loans like we're going to pay them off over the course of 30 years, 360 payments. You know what informs the interest rate you get? The market. What is the market? It's all the other banks that want to lend you money, and they get to fight over who's going to give you the best rate. One of the things they consider is what are one-night interest rates right now. That's one thing. There's a whole bunch of other things. I don't think I have enough energy to explain it. Interest rates went down. The 10-year treasury went up. Which one is right? I don't know. They're both the same thing. Or they're both different things. They both happened at the same time. They're both real. Interest rates went down. I guess for the average person, what that actually practically means is the interest you're making on your savings account went down a little bit. That's something. I guess that's notable, but let's think about it practically. So if you had a top of the line savings account and a month ago it was paying you 5%, and now all of a sudden interest rates get cut and you have one that's paying 4.5%, it's 0.5% difference over the course of a year. Let's just math. Okay. Math. You have $100,000 in cash. Is that a lot of cash or a little cash? I have no idea, but it's an easy number for me to use. Okay, let's make it $10,000. $10,000 in cash in the bank at 5%. That's $500 a year. $500 a year, that's $40 a month. Don't argue. It's $40 a month. Shut up. I know what you're thinking. It's $40 a month. Now it went from $500 a year to $450 a year because interest rates got cut. So your 5% savings account is now 4.5%. It's $450 a year. Okay, ready for my math? Still $40 a month. Did it change your life? No. Just stop. Okay. I can't. I'm just done with the TikTok influencers who have $10,000 in their savings account telling us that we should change the way that we live our lives because we had a 50 basis point interest rate cut. It's just impractical for most people. Mortgage rates have been coming down for like 3 months. 3 months before this interest rate cut. You know why? Because the market is what informs mortgage rates. It just is. It's a 30-year product. It's just how it works, okay? I'm sorry. If you can't understand that, I don't know what to tell you. Should you pay it off? I don't know. Depends. Here's the thing. When you have a mortgage, most of the time, that monthly payment is fixed. So, on average, that means it changes every month by $0. That's your mortgage payment. Now, there's other things. I'm not even going to talk about those. Taxes, insurance, which is insane, repairs, etc. Some of that stuff's in your mortgage. Some of it's not. Some of it could be. Some of it doesn't have to be. Whatever. But your principal and interest payment, that doesn't change. Unless you have one of these adjustable rate mortgages, I don't want to deal with exceptions. Principal and interest rate payment doesn't change. On average, over 30 years, you make more money. Now, people live in houses for like not very long anymore. I don't know, 4 years. What's the average? Okay, Google, ready? How long do people live in houses on average?
On the website, thezebra.com,
Whoa.
they say 16
Can you hear that?
lived in
I said, okay, Google, and then typical U.S. homeowner spends 12.3 years in their home. Okay, I'm going to do something. So let's just pretend that you have a 30-year mortgage and, okay, I'm going to look up current interest rates. I'm not going to make this up, 6%. Okay, calculate. After 12 years, you would have paid off, dun, 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 that's almost halfway into your loan. 30-year mortgage is halfway is 15 years. So 12 years, it's 40%. 40% the way into your loan. You would have paid off 20% of your mortgage at that point in time on 6%. Did you know that? Well, that's just math. So if you live in your house for anything less than 12 years, that means you would have paid off something less than 20%. Okay, let me do like 9% really quick, just for giggles. So if you have a 9% rate, mind you, 9% is 50% more than 6%. Again, that's just math, but maybe that's another podcast. Okay, 9% interest rate, 12 years, you would have paid off 14%, 15% of your mortgage after 12 years. Is that meaningfully different or not? I don't know. I think the thing that people need to realize is when you live in a house for something less than, like, let's say even half the mortgage life, 15 years, like you're paying off meaningfully less than half of the balance. That means that from a debt pay down perspective, interest rates, the change is going to be, let's say, somewhat more marginal than people think. Now, the difference between 3 and 6 is a lot, and the difference between 6 and 9 is a lot, and there's a lot of forces that make interest rates operate in those windows. But pretty much all of the appreciation you're going to find in a house, almost exclusively for most people, because they don't live in their house very long, is from market change, price change, the value of your house changing, going up in price. The thing that interest rates are going to inform a lot are your monthly payment. So a more practical question for most people, rather than should I pay it off, because the reality is most people can't. It's just factually correct. Should you pay off your mortgage? Yeah, if it reduces your monthly payment to the point that it makes sense, maybe. But when you refinance a mortgage, you're going to have to pay closing costs. Typically, they're just going to roll that into the balance of the loan. So you'll feel a little better about yourself. So you're not going to have to come out of pocket for those closing costs, but they are real. And at some point, there's going to be a point in which the amount that you're saving every month doesn't yet pay back the amount of the closing costs. Let's say closing costs are like 1% of a loan. Simple math. Okay. You've got $300,000 on your mortgage. Closing costs are 1% of your loan. To go from 8% to 6%. And going from 8% to 6% saves you $100 a month. I don't know, I'm just making up numbers. Maybe that's right. 30 years, you refinance your loan. You save $100 a month, but you added $3,000 to the balance. $100 a month is what you saved. You add $3,000 to your loan balance. Now you got a $303,000 mortgage, but you're paying $100 less. Well, you're only really paying $100 less if you live in the house for longer than 30 months, because 30 months is your crossover. $100 a month for 30 months saves you $3,000. People can't predict what they're going to do in the future. And I especially think that on average, the younger person's life today is way more volatile than the average 30-year-old person's life was 50 years ago. Because on average, you don't have kids and you're not married and you're on your fourth job. Unlike mom and dad, or mom's mom and mom's dad, it's a different generation. And you think you can work on the internet all day until you have to go back to the office, Amazon. Sorry. Does it make sense? Maybe, I guess. Sorry. To some people, saving $100 is a lot. To some people, it's not. It's just true. So I can't tell you if $100 is going to be worth it or not. I can't. $100 a year is $1,200 a month. You know, how many hours does it take you to refinance your car? If it takes you 5 hours or 6 hours to refinance your car, that's $200 an hour over the course of a year that you made. For some people, that's a lot. For some people, that's not. I'm not saying it is or it isn't, but these are things that people don't think about. Interest rates. It's not the end of the world. Honestly, it's not really even anything. Okay, interest rates get cut. Inflation goes up, goes down. Where does it go? I think the theory, well, actually, I'm not going to opine on this. Here's why. So, inflation happened, like COVID, right? Let's just agree that our everybody's baseline level of knowledge that's listening to this still here at this moment is that COVID happened and then inflation happened. Let's just agree that we all know that for a second. And then the strategy was to raise interest rates to combat inflation. But if you use just kind of logical, like, let's say, cause and effect thinking, if you actually put on your thinking cap, you would look at that and go, wait a second. So if interest rates went up and we want to, or if inflation goes up and we want to curb inflation by raising interest rates, the logical cause and effect thinking is that cutting interest rates in the first place is what caused inflation to go up. If we think that raising the interest rates, this is 4 years ago, is going to be what brings inflation down, logically you would have thought that cutting interest rates in the first place is what brought inflation up. But that's not what happened. I think it's actually pretty, let's say, widely accepted knowledge at this point in time that the reason inflation happened 3, 4, 5 years ago with COVID is that there was just more money in the system. Where did all the extra money come from? Stimulus checks, PPP loans, unemployment, student loan deferrals, which are still happening. That's just more money that's available to be spent on stuff. When there's more money that's available to be spent on stuff, prices have to go up. That isn't even like a controversial statement. That's not even a theory. Just it's actually true. If there is one car in the car sales lot and there's 10 buyers, the person who offers the most for that car is going to buy it. This happened with houses, like a lot, okay? So everybody should know this. If there's one house and there's 10 buyers, that house price is just going to go up until the highest bidder is found. If there's 10 houses and one buyer, they're going to have a pretty easy time getting a good deal on one of those houses because there's not that much money chasing those goods and services. If there's a lot of money chasing less goods and services, it's all relative. So you can just simply add money and de facto goods and services go down. It's all relative. If there's just more money in the system, prices have to go up to accommodate. What does that have to do with interest rates? Literally nothing. So we tried to solve the problem by raising interest rates. So I suppose the theory is today, I don't know, I don't run the government, I just live here. I suppose the theory is, well, inflation is now coming back down because of the interest rates that we raised 5 years ago. So it's safe for us to start cutting interest rates again because everybody likes to live in a low interest rate environment because, life is a lot easier when I can borrow $1 million for free. That's the theory, I think. But here's the deal. You know why they actually cut interest rates? They cut interest rates because, popularly, they thought they think they can handle inflation. You know why they actually cut interest rates? Because you know who pays interest. You know who pays the most interest out of every entity that pays interest ever? The freaking government. Okay? So, yeah, your bank interest rates go up or they go down or whatever. You know who's on the other end of that trade? The literal US government. So I'm on a government website. This is the Federal Reserve of St. Louis. And what it shows me is this graph. It's a line chart over time showing the change in, it's called federal outlays. Interest as a percent of gross domestic product. What does that mean? Basically, what percentage of the government's income do they use to pay interest on their own debt? That is what I'm looking at. You could equate that to if you make money and you have debt and you pay that debt off, some percentage of that debt payment goes to pay down the principal of your loan. It reduces the balance of your loan, and some percentage of that debt payment goes to pay interest. That is the two places your debt payment goes. If you were to just run that metric for the government and say, okay, what percentage of the government's income goes to pay debt right now is 2.37%. Is that high or low? I have no idea. I would tell you that in 1991, it looks like, I'm looking on this chart, it goes back about 100 years. So that's how much data we have. 1991, it peaked out at 3.15%. 95 was still about 3%, and then it tanked. 2003, 2004 is about 1.3%. And it kind of hovered in there till about 2015, 16. It went up to about 1.75 in 2019. And then more recently, it's gone from that range to about 2.37, but it's been a vertical straight up. Why is that? Because the government has had interest rates at the floor, like zero, literally, for a long time. And they issued a bunch of debt at that rate. And now, this year and last year, the last couple of years, that debt has been maturing. And the government's not out of debt. When the government has to pay off its debt, guess how it does that? It simply issues more debt. So all of a sudden, the government that had these, 5, 10, 15-year notes, debt, we call them treasuries, that are maturing, that were paying 1%, 2% in interest, they're maturing now, and the government has to go and reissue that debt. And now all of a sudden, the interest rate on those new loans has gone up pretty dramatically. So when they were paying, like 0.5%, I think the 10-year treasury. Yeah. So if you were to look at the 10-year treasury in 2020, I'm pretty sure it bottoms at 0.5%, meaning the government could go issue debt at 0.5%, pay interest of 0.5% for 10 years, and then have to pay that debt off. Right now, it's gone up to, earlier this year is up over 4.5. That doesn't sound like a big difference, but the difference between 0.5% and 4.5% is 9x. In pretty short order, the government had a bunch of debt coming due at very low interest rates, and it was reissuing that debt at very high interest rates, relatively speaking, higher interest rates. And now all of a sudden, the percentage of the money they have to pay out of their revenue toward interest has gone up basically double since, 7-8 years ago. And by the way, if they keep interest rates at this rate right now, that number will go up. It will go up a lot. So the government quite literally can't afford to keep interest rates higher, because otherwise they're going to be spending all their money on interest. Today they couldn't even afford the debt to begin with, but now it's all going back out in the form of interest payments. So they literally are incented to keep rates lower. It has nothing to do with you and me or the economy. It's the fact the government can't pay its own debt. Therefore, they have to put interest rates to the floor. Otherwise, they're going to run out of money. Alternatively, they could just issue 100-year bonds. Nobody wants to do that, but maybe they should. Okay, there's my solution for the day. That's what I got to say. All right, we'll see you next time.